Okay, greetings and welcome everyone to our virtual panel, Inflation, How Private Equity-Backed Executives Can Fight Back. My name is Rob Huxtable, and I'm pleased to be your host for the next 60 minutes. To say the least, it's been an interesting time to lead a private equity-backed company. The operating environment over the last 2 years has been an absolute gauntlet, from COVID to supply chain pressure, to labor challenges, premium multiples, rising rates, and if all that weren't enough, we're now facing serious levels of inflation, topped off with a potential recession waiting in the wings. Having said that, I, for one, am encouraged by the fact that private equity is built to handle stormy weather. Our asset class has hallmarks of extreme urgency, speed of decision-making, and a bias for execution, and those will be more essential now than ever. And ironically, it seems all we need to do is execute what's in our playbooks, but at a more acute level. And we'll go ahead and meet this fear and doubt head on with massive action and some decisive leadership. So with that in mind, glad to have you all here today. A couple quick housekeeping items, and then we'll get right into it. This event is being recorded, and it will be posted live on PrivateEquityCXO in the coming days. Per our registration terms, this event is closed to the media. Thank you. And time permitting, we'll take a few questions from the audience, and although chat is turned off, we will put in the broad chat my colleague Lindsay's email address, and if you have a question, please email her real time, and she'll filter them over to me. So we're going to stay light on commercials, heavy on content, but simply for context, today's panel is a private equity CXO event. PECXO is the largest community of sponsor-backed executives, and its mission is to continuously grow and strengthen the professional ranks of portfolio company executives around the world so that we can all ensure a healthy private equity ecosystem for years to come and decades to come, for that matter. I'm your host, Rob Huxtable. I'm founder and partner with Falcon. We are a retained search firm that focuses exclusively on portfolio company CEO, CFO, and chief revenue officer searches across North America. And we are very proud to serve a number of outstanding top quartile clients. So with all that said, let's get into it and meet our VIP participants. Let's start by welcoming our keynote presenter, Kristina Hooper, who is Invesco's Chief Global Market Strategist. Kristina, welcome.
Thanks so much for having me.
Okay, great to have you. She'll be leading us through a macro presentation, after which we'll dig into a robust discussion and hear from a powerhouse panel of private equity veterans with elite track records of value creation. So let's say hi to Annmarie Neal from Hellman Friedman. Annmarie, could you just briefly give us a sense of your role and where Hellman likes to invest?
Yeah, sure. Hi, Rob, and greetings, everyone. I'm Annmarie Neal. I'm a partner and the Chief Talent Officer at Hellman Friedman. I've been there 8 years, and we are predominantly investing in growth, high tech, tech, retail, fintech, and healthcare. And we've got about 90 billion of assets under management right now.
Okay. Terrific. Well, thank you so much. And Annmarie is Chief Talent Officer at Hellman Friedman, also a full partner. And prior to that, Chief Talent Officer of Cisco Systems, among others. So has a great sense of all the fun challenges we're dealing with in this environment around labor supply and workforce management. Next, let's say hi to Chris Nimsger Weston. Chris, greetings, welcome from Thoma Bravo. If you could give us a quick hello and overview of your firm and what you focus on.
Absolutely. Thanks, Rob. Happy to be here. Kristin Weston. I'm an operating partner with Thoma Bravo. And Thoma Bravo is a software-only investor as of August. I think we've got a little over 100 billion in assets under management across 3 fund families. And I would say strategically, one of the hallmarks of our investment strategy is to really take an operational approach to software investing. And so my role as an operating partner is to partner with the portfolio company management teams at the C level and help them provide with some perspective from across the portfolio and the broad universe to help get to our enterprise value creation goals.
Wonderful. And prior to joining Thoma, Chris is a 2-time exit veteran, backed both times by Vista Equity. So she's seen what good looks like at scale, to say the least. And then finally, we have Stewart Kohl, who is co-CEO of Riverside. Stewart, welcome.
Thank you, Rob. It's been my great pleasure for the last 30 years to be the co-CEO of Riverside. We have about 15 billion of assets under management. During that period of time, we've invested in over 800 of these small but mighty companies, growing, profitable, and needing our capital, both financial and intellectual. We operate across North America, Europe, and Australia.
Okay, wonderful. So without any further ado, I'll be working the mouse with Kristina's guidance, and she'll take us through an overview of the macro environment before we jump into the panel.
Thanks so much. It is such a pleasure to be with you all. And Rob, thanks for working the mouse. I'm one of those people who can't walk and chew gum at the same time. So I appreciate all the outpatient support I can get. So to really think about and understand where we are today, I think it's helpful to turn to the next slide, which gives a sense of what's happened during the pandemic and its recovery relative to past business cycles. So on the left-hand side, you'll see the past 5 or so US business cycles. On the right-hand side, you'll see the past 5 or so G7 business cycles. And what I think is really important and obvious to see is just how dramatic the pandemic was, even relative to the global financial crisis, right? We look at the GFC and it's barely U-shaped. And yet, if you look at the global financial crisis, it is truly, if you look at the pandemic, it is truly a V-shaped business cycle in its early stages. And that really reflects the fact that we turned off an economy, and not just the US, as we know, globally, we turned off economies and then we turned them back on. But we turned them back on with more voltage, right? We had a situation, unlike the global financial crisis, where we threw a lot of fiscal stimulus at the economy, in addition to monetary stimulus, which we did during the GFC as well, but far more this time around. And so we're in a situation where, not surprisingly, the economy took off quite dramatically and recovered rather quickly. Now, this to me has the makings of, and what we're seeing is classic demand pull inflation. Just to go back to the textbooks, there are essentially 5 different causes of demand pull inflation. Any one of them can create it. But actually, we had multiple causes occur. Multiple factors have contributed to the environment we're in. And I'm just going to walk you through them. A growing economy, when there's more spending, that is when we, of course, see some level of demand pull inflation. But there are other factors that we've seen. Government spending. When the government spends more, prices go up. Inflation expectations. Companies increase their prices in expectation of inflation in the near future. And then finally, more money in the system. And of course, money supply has been significant. So there have been a number of factors that have contributed to where we are today. And of course, we want to get a sense of where we're going from here. And there are some factors that are going to be easier to divine than others. That's just the nature of economics. So if you turn to the next slide, what we tried to do was lay out our base case as well as 2 tail risk scenarios for the current environment. Because keep in mind, not only did we have all those factors I just talked about, but then at the start of 2022, we saw Russia invade Ukraine and we saw Omicron hit China. China's policies up until then had really been able to combat COVID so well, but Omicron was a lot more infectious. And as a result, as we know, supply chains were disrupted. So when we set out to come up with an outlook for the back half of 2022 and beyond, we really felt so much of it hinged on where the Russia-Ukraine war goes, right? Does it exacerbate? Do we see some improvement in conditions? Our base case, though, is that it remains status quo. And that would create an environment where you see inflation peaking probably around now, some point in the middle of the year. It could take a few more months, but we're seeing core moderating a bit, and it seems that headline is likely to follow. In this environment, we think the U.S. can, well, we're in a technical recession, but we think the U.S. can avoid a wide scale decline across many industries, which is the way Jay Powell likes to describe a recession. I think the U.S. will be able to avoid it. It's going to be a lot harder for the Eurozone, for example. And some of that has to do with the nature of their inflation, right? In the U.S., it's a combination of demand-driven, of commodity prices. There's a lot that has gone into U.S. inflation, and some of it can be controlled to a certain extent by the Fed. That's not the case in the Eurozone, where so much of inflation has been driven by energy in particular. So they have a more difficult scenario. I'll talk a little bit about our downside tail risk, which is as a flare-up in Russia, Ukraine, in the Russia-Ukraine conflict. And of course, Russia cuts off gas supply, or there's some kind of embargo there. That would be a real problem for commodities and commodity inflation. But let me turn to one source of significant inflation that we've seen, and that has been supply chain. So if you turn to the next chart, what you'll see is the New York Fed's Global Supply Chain Pressure Index. The Fed seems to have an index for everything, and luckily one of those things is the global supply chain. And what you see here is that there has been a nice decline in recent months. And the last month, what we've seen is that was largely driven by an improvement in China's supply delivery times. No surprise, given that so many cities have reopened. Now, the question becomes, what happens to supply chains going forward? And it seems a lot of it hinges on China, and a lot of it hinges on COVID, because in the near term, there's not going to be a lot of benefits from friendshoring or moving supply chains. This is too short a time frame for that. So it's largely going to be dependent upon how really China manages COVID. And we're actually encouraged by what we've seen in terms of a real evolution and adaptation of zero COVID policy. It's now, I believe the technical term is now dynamic social zero COVID. And it's really about targeting smaller and smaller areas for shutdowns. So we wouldn't see the wide scale, or presumably wouldn't see the wide scale shutdowns that we saw in March and April that were so problematic. So I'm optimistic that there will be some kind of improvement there, that we'll continue to see ongoing improvement. It doesn't mean we won't see hiccups, but I think that more surgical targeting of COVID will be a real help going forward. Again, this is really visibility through the end of this year, but I think we'll see that continue to come down that chart. So then let's turn to wage growth, because that is traditionally viewed by economists as the stickiest form of inflation. We all know when you raise pay, it's hard to reduce it, and that is generally true. Although I would say in the U.S., where we have seen significant wage growth, it's not that we haven't seen wage growth across the board, but where we have tended to see the most significant wage growth has been in the lower paying jobs, the retail jobs, the hospitality jobs. And I would argue that actually makes this picture slightly better. There's high turnover in these industries, so it's essentially the least sticky part of the sticky part of inflation. And we're actually starting to see some improvement there. Now, there's this argument that just look at the Phillips curve, right? There's a relationship, a trade-off essentially between unemployment and inflation. And so we have to see essentially the Fed execute a large enough slowdown that unemployment can go up enough that we have an easing of wage growth. But I actually think there's a kinder, gentler way to get there. And it's largely because of where the US labor market is today, right? We're at, I'm going to give you the exact numbers. The jobs to workers gap is currently 4.6 million workers, or 2.8% of the overall workforce. And that's really the highest level that we've seen in the post-war economy. And so that suggests that we could see job openings slashed and get the same impact as slashing jobs. Now, that's not to say we're not going to see job cuts. We've already seen some announced. But we've also seen a real slashing of job openings. In fact, just today, the most recent data showed that job openings declined more than expected. We've seen a decline now to 605,000 from over 1 million. So there's a lot of wiggle room, I think, to see more improvement. There's a lot of wiggle room for companies trying to manage expenses. The incentive to cut job openings as opposed to jobs is that many companies are operating with a relatively, essentially something, I don't want to over exaggerate, but something akin to a skeleton crew where they don't have enough jobs filled currently. So that this could make a lot of sense in terms of how they manage expenses. Now, that has a really nice knock-on effect because it tends to be job mobility that enables wage growth to be so significant. And that's really the condition we've seen. So if there isn't job availability, if there isn't job mobility, we're likely to see a tamping down of wage growth. And in fact, in recent earnings calls and the guidance we've gotten from companies, they've suggested that. And I'm just going to give you a few examples. Cheesecake Factory said that we may be starting to see some early signs that inflation has peaked, including the lowest level of year-over-year wage inflation so far. Darden Restaurant said they're seeing applicant flow that's significant, and it's helping them level off wage inflation over time. So just to me, some bright spots there. And I think there's a real potential with this very tight labor market to see a real improvement in wage growth without seeing, mass job losses. I'll also point to the Federal Reserve Beige Book, the most recent one that came out in July. Essentially, that only about 25% of Fed districts reported expectations that wage growth will remain elevated for the next 6 months. A few expected wage pressures to subside. It's less of a concern. There are certainly non-labor costs that are peppered throughout the Federal Reserve Beige Book, but it seems to be an improvement. And in fact, Goldman Sachs research reported that across the 88 Dow Jones mid or large cap consumer companies that discussed the labor market on earnings calls, 35 companies signaled improved labor availability compared to only one that saw labor shortages worsening. And all three of the human resources and staffing firms that commented cited improved labor availability. And some of those companies also mentioned an easing of wage growth pressures. So I think there's actually some real potential there again, and I'm quite optimistic about that space. Clearly, the Fed is helping by tightening financial conditions. So then it all becomes about inflation expectations. And we know the Fed cares a lot about that, in particular, consumer inflation expectations. If you turn to the next slide, you'll see that the New York Fed's survey of consumer inflation expectations for 3 years ahead has improved. You'll note 1 year ahead hasn't. I'm not surprised, although I think we'll probably see some moderation soon, just because there's a very direct correlation typically between the 1 year ahead and headline inflation, so energy and food costs. So as gas prices at the pump come down a bit, that should impact 1 year ahead. But the Fed is focused on longer term. You may recall The language we hear from Jay Powell a lot, that's also in some of the FOMC minutes. They want to see that longer term inflation expectations remain well anchored. Now, business inflation expectations, interestingly, moderated modestly this fall. This is for the 1 year, this spring. This is for the 1 year ahead period. They've stood still for the last couple of months. We might see those expectations come down, but it's about the longer term. And right now, the picture is improving there for longer term inflation expectations. If you turn to the next slide, you'll see more confirmation of that with the 5 year ahead inflation expectations coming from the University of Michigan survey. They've shown real improvement. We've been at the 3 handle really since since the start of the year, and now it's come below that. It's at 2.9%. That's important. That's certainly closer to the Fed's 2% inflation target. Not there yet by a long stretch, but it's moving in the right direction. And I think that that's very, very important consideration for the Fed. In fact, what we saw at the June meeting was that they one of the reasons they hiked rates 75 basis points was because inflation expectations had gone up in the preliminary reading. That proved to be something of a false reading, but they acted on it. And so this is important because it's so different than, for example, what we saw in the 1970s and the mindset of consumers back then. If you turn to the next slide, you'll see that this juxtaposes the Michigan surveys from February of 80, September of 90, and June of 2022. And so what do we see? We see that for those previous periods, 5 year ahead was almost identical to 1 year ahead. Now that creates a mentality where consumers want to sit on their hands, where consumers want to buy because they expect prices to continue to go up. There's no waiting and sitting on their hands to purchase something. It's a very different story today where the 5 year ahead is far lower than the 1 year ahead. And I think that makes a lot of sense in terms of the kind of consumer behavior we're seeing, where many consumers, if they don't have to make a purchase, or especially a big ticket item, will sit on their hands and not do it. And the good news is that then it becomes a self-fulfilling prophecy, right? That if you expect prices to go down and you sit on your hands, typically they will go down because at the end of the day, it's too many dollars chasing too few goods. That changes that equation. That didn't happen in the 80s and 90s. In the early 90s, I think it was a very different mindset, and inflation in the 80s in particular was very problematic. But we're in a very different place today, and I think that's important to stress. So, of course, the one risk scenario is commodity prices. And as I said, that largely is dependent on the Russia-Ukraine crisis. And as you can see from this slide, we could potentially see a complete cutoff of energy, of Russian energy. That is our worst case scenario. Now, I should say that the epicenter of the problems here would be in the Eurozone. They're bearing the brunt of it now, and that would only magnify it. So I think that sends the Eurozone into a stagflationary environment. It's going to be very, very problematic. Much more likely to experience a real recession than other parts of the world. Hopefully this can be avoided. What we are seeing is the Eurozone trying to come up with alternate sources of energy and trying to reduce dependence, essentially being forced to with a very, very short timeline. Luckily, the US is in a very different place because we're energy independent, at least far more energy independent than we were in the 70s. So let me stop there. Hopefully I didn't take too much time, but just kind of wanted to give you an overview of inflation. Again, the key takeaway is that I would anticipate it start to peak. That doesn't mean we're getting down anywhere near the Fed's target, but we should see the start of moderation. I think it's going to take through, until the middle or end of 2023 to get back close to the Fed's target or at the Fed's target. Thank you, Rob.
Kristina, great stuff. Panelists, any follow-up questions for Kristina?
I do. If I could take one, Kristina, you just because you're on this slide right here and you're talking about commodities and the impact of Russian war, et cetera. And I also think in terms of labor and labor supply out of some of these regions, Chris probably sees the same. A lot of the tech companies have put operations centers, call centers, tech centers, product centers in what you have here, your danger zone. So maybe you could say a point or two on the supply chain for labor in what that might look like given in some of these zones that you're referencing here.
Sure. So this is a danger zone in terms of energy prices. So these countries are extremely dependent upon natural gas from Russia. They're very dependent on natural gas as an energy source and natural gas from Russia. So in general, I think that just creates higher operating costs, right? There is that wage price spiral theory of inflation, that when costs go up for workers, they demand more pay. When they see inflation go up, they demand more pay. And so I think that's a very likely outcome if we were to see this worst case scenario, that many are just struggling to pay basic bills, and companies have to increase their pay. And of course there are probably some other additional costs just in terms of paying for energy to fuel, to fuel operations. But in general, I think that it does create pressures, cost pressures that could be significant, again, depending upon how severe a cutoff would be and how long it lasts.
Great. Stewart, Chris, anything else?
No, I just agree with what Annmarie said. The one thing I would note with respect to that region and specifically across our portfolio is I've been pretty impressed by the speed at which people have adjusted across our portfolio. And so it's been a combination of actions, first and foremost, providing some support for employees in the region. And certainly we have a lot of employees in the region. And the vast majority of our companies have tried to either support those employees in place or offer them assistance with relocation to more stable environments. But I would say the majority of our companies, setting aside the energy piece specifically, with what Annmarie said, specifically, most of our portfolio companies have made a pretty rapid adjustment over the last 6 months and have reached mostly a period of stability, at least for the current moment, relative to staffing and labor in that region.
Yeah, ours have too. It's just a great market for talent. If it's becoming restricted or more difficult or more costly, all those sorts of things was what really my mind was going. Yeah,
absolutely.
And Rob, on behalf of maybe many of the CEOs and CFOs out in listener land, Kristina, if you were running one of those companies and you had the option to insource something, whether it's manufacturing or BPO or back office services, whether it's continuing to aggressively push things offshore for reducing cost, and you're looking at your crystal ball for what labor costs in the U.S., and I'm guessing the bulk of this audience, Rob, is U.S. or U.S. domiciled companies, what would your advice be?
Oh, I think that's above my pay grade, but the U.S. Is this a choice between the U.S. and the Eurozone, or just the entire world?
Apologies, I'm thinking the whole world, because most of us are not outsourcing to the Eurozone.
Well, so there's clearly a reason that a lot of businesses are outsourcing to India, and other sort of Southeast Asian countries that have very knowledgeable, skilled workforces, and don't necessarily have the kind of wage growth that we've seen in China. So I would imagine that there's a desire to diversify, right? So we'd want to have multiple locations, multiple geographical risk exposures, so to speak. And it's not to say that wage growth is going to be minimal, but I think wage expenses in general the risk reward trade-off is quite good for a lot of the Southeast Asian countries and in particular India.
Okay, terrific. So, Annmarie, I'm sure your phone rings off the hook daily with questions about talent and labor and workforce management. So why is it so hard now, even in light of all the issues we've described? And what have you seen that's been effective at combating some of these headwinds?
Yeah, so it is very hard. It's probably the hardest talent market I've seen in my career. Differently difficult. A lot of the things Kristina is talking about, it's really supply, that supply demand. A lot of people left the workforce through the pandemic for a variety of reasons. Some left because they could retire, some left because they found something passionate to go do that filled their heart differently than the work they were doing currently. Some left because jobs went away, some left with automation, et cetera. So people have left and found new ways. The gig economy has created a lot of new ways for people to feed their families and take care of their needs. I also think employees have become a whole lot more precise about what they will and won't put up with from an employer. And so those organizations that have been great talent, great culture organizations before the pandemic, really good, not pretend to be good with lots of food and cafeterias and, warm toilet seats and all those fancy things you'll get in the Bay Area, but really good about, our people are important and they belong and there's a esprit de corps in the building, even metaphorically. Those organizations, I think, are doing a little bit better than the organizations that have had just more difficult cultures in general. The toxic culture no longer can really be viable in this market. And so it's really, people are just saying, look, if I'm going to go to work every day, I'm going to go to work with people I want to be with, company that has vision and mission, a place where I belong, I can bring my quote unquote authentic self, all that sort of stuff. So a more discriminating population. And then, the movement that Kristina talked about, everybody moving around has just pushed the market up from a I'm more valuable than I thought I was. And oh, by the way, someone will pay me that for that value. And so it's really thrown the whole talent acquisition world upside down. It's thrown our compensation structures, upside down. It certainly has a lot of CHROs and CFOs not sleeping fully at night, as a result. And I think, if I look at it, really creative heads of HR are doing a good job because they're getting really creative. Those that have wash, rinse, repeat along their career are really struggling because this is not a wash, rinse, repeat world. This is you have to be scrappy and creative and thoughtful, and you really need to understand how to do strategic talent management in order to help your management team and organization thrive in this environment.
Any examples of being creative top of mind?
You sure, you don't have to just give everybody a raise. You could, show up with, variable bonus structures that help those employees that are most at risk, or those employees that are most at need, or those employees that create most value for the organization. And you can much more strategically, push resources to those that are going to really pay off for the business longer term. I see that as big. I see organizations stepping back and being much more thoughtful about mission and volunteerism and social cause, post the social injustice of that emerged through the pandemic. Employees want to attach to something more meaningful. And so, if you're not presenting a meaningful environment for your employees are going to go find meaning elsewhere, whether it's playing golf on the golf course or, going to another organization. So, bringing that alive in the organization versus not, that would be two big creative ways I've seen some of our more strategic HR leaders take the lead. And Chris, you're nodding. You're probably seeing a lot of stuff too, because we're circling in some of the same organizations. So
Yeah, we absolutely are. And I agree with everything that you said, Annmarie. I think one of the early errors that some of our executives made, to your point, is to try to solve the problem of departures with just money, right? Like throw money at the problem, and wages are going up. And I think the more successful executives in our portfolio have been the ones that are at the forefront of acknowledging the elements of a changed labor world. And to your point, number one for us, at least for me, is geography. Like companies have largely become untethered from the geographies in which they're headquartered. And that presents both challenges and opportunities, meaning their local talent pools can look elsewhere and they can look elsewhere as well. And so the companies that really embrace that combination of remote work and broader geographic landscape, I think have been more successful. And to amplify what you said, again, I don't feel like just throwing wages at the problem has been remotely successful in any of the companies. And instead, people are, not everyone cares about mission, but some people do. And so I like to call it kind of this, they're looking for a purpose match. So it could be that this company's very, I've actually had some employees say my company is too focused on social causes, or this one's not enough. And so instead there's this match between how purpose-driven is my company and what do I want? How purpose-driven do I want my company to be? And then again, a little bit of amplification, but the last point that I see there is that leadership quality has become more important than ever, and difficult to connect necessarily. You're not doing the walk around, as you said, the sandwiches style of leadership, and any HR leader in our portfolio that says they're going to throw more free lunch at it is sort of missing the boat, because truly articulating a compelling and inspiring vision about where the company is headed and how that's going to create future career opportunities that align with the goals of the individuals. And so in some respects, I hope executives view it as emancipating, because you really just have to articulate a strong growth mission and then march in that direction. And the employees will be opting in and out based on their own goals. And I think there's less sort of, nailing people down than there, the need to do that, rather than making sure you create an environment where there's clarity of purpose and clarity of vision and people can opt in.
Yeah, powerful. Stewart, any thoughts on that topic?
No, I love the discussion, love the direction we're going. I know at Riverside, we are spending more time. We've always spent a lot of time talking about what we do and how we do it. Now we're spending a lot more time also talking about why we do it. And I do think that that resonates with our folks, even at a, let's face it, private equity firms aren't necessarily known for being warm and cuddly places to work. But even here, I think that really resonates.
Okay, terrific. So Chris, if I could turn to you on the topic of pricing. It's been a lever that private equity's used for a long time, but there's still a lot of inconsistencies out there and probably pricing opportunities that have been left on the table. Curious what best practices you've seen, and then, bigger picture, how does it play into the value creation ecosystem and what you're seeing from the tech sector?
Yeah, absolutely. And I do think some of the dynamics that we've seen are specific to the tech sector, although I think they have certainly bleed over effects in other areas. And just as, some of the things that happened that Kristina was alluding to from an economic perspective at the start of the pandemic, from my perspective, absolutely accelerated some underlying trends that were already at play in the tech sector. And, certainly others have spoken about them in other settings, but of course, the migration to the cloud, while that was well underway, was dramatically accelerated. Democratization of content absolutely accelerated. The remote work environment, digitization and automation, all of those things accelerated dramatically during the period where almost every enterprise was in a remote environment. And all of those things created tailwinds for the overall technology sector. And we saw, after the initial shock, if you will, wore off, and the sort of the paralysis of the first several weeks or maybe a couple of months of the pandemic, we saw growth in the majority of our portfolio companies, unless they were in a particularly challenged market, like restaurant back-end software or something like that. So all of the other sectors saw tailwinds during the pandemic. And I think the broader value that creates is as there's a greater recognition of the need for automation and for efficiency. If you think about the fundamentals of software are almost always automating or improving a human-intensive process that was historically a human-intensive process. So it's making something better, faster, more accurate. And so all of those things accelerated. And the way that we really counsel our companies, and I would counsel any company, is to think about that broader price as part of a broader equation around the overall value of what that product is providing. So we really would counsel our executives to look at what process is that replacing and doing the math on that total return on investment or that total value calculation. And that permits some conversations with the purchasers and largely enterprise purchasers in our environment to understand really what they are replacing. And then that changes the price tolerance equation. So instead of looking at this piece of software cost X in the past, and this is what it costs today, you can think about what are the capabilities of that software, what are the deployment model for that software, and what are you gaining in an efficiency in your organization by using technology to solve, again, a formerly human-intensive processes. So that's really part of the overall discussion that we would have around trying to determine that price equation, and certainly plays into all of the other dynamics in the software world, and in particular around recurring revenue and then that compounding effect that we all seek over time. And I think as we engage and our portfolio companies engage with the purchasers and the enterprise purchasers, it's really helping them understand, to play on the other conversation, it's also helping them understand that continued expansion of price is a reflection both of increased capabilities and therefore efficiency, but also a reflection of a healthy software ecosystem, which fundamentally creates opportunities for employees, which makes a more healthy environment and allows those organizations to continue to innovate and create more value for the purchasers over time. And so it is, to your point, Rob, a much more complicated equation than just, hey, we're throwing plus 5%, thank you very much, and calling on the broader economic factors, but really looking at it from a much more holistic perspective. That said, I would say what we have seen in our portfolio is there is a recognition of that macro environment right now as well. And so a little bit of urgency, I would say, in most companies to ensure that the price strategy that's employed, whether it's an increase or a rationalization or an expression, is in line during this period, because there seems to be a bit more amenability to those conversations than there has been in the past. And I think there's a hypothesis that there's some expiration on that amenability to discuss price as well.
No, that's great. And Stewart and Annmarie, as you think about it, the two-sided coin, not only are your portfolio companies trying to raise prices in the market, but they're the recipient of prices being raised upon them by their suppliers. Any thoughts on that broader vicious circle?
Yeah, I mean, that's very much the game right now. I want to pick up a little bit on what Kristin was saying, which was fascinating. We've been, as you know, Rob, very focused on recurring revenue businesses across Riverside. And have generally felt that's the advantage business model, and it is. But one thing we didn't appreciate before this period was that in a period of inflation and rising prices, those 1 year, in some cases 3 year and 5 year contracts that we touted, we thought were great, make it much harder for us to turn around and pass along price increases to our customers. Live by the sword, die by the sword. So that's it may be shame on us, but after 40 years of relatively little inflation, if things were inflating at 2 or 3% a year, it was easy to bake that in and be happy. Now, if we're looking at, as Kristin is suggesting, 5% or more inflation, let alone if it stays at something like 8 or 9%. And I know I'm spending time for the first time, I'm dusting back off what I learned in college 100 years ago and what I practiced in business 50 years ago. When people talk about growth rates for companies, is that real or nominal? Because a mid or high single digits growth rate is actually not too bad in a 2% inflation environment. it's terrible if we are going to have an inflation period now that's 7, 8, or 9%.
Annmarie, any thoughts on the pricing scheme, or is that a little bit of a different lane for some of your other colleagues?
The pricing scheme only adds labor cost at the end, because ultimately at the very end of that value chain is the consumer that happens to be an employee. So it's a big circle, as Kristina mentioned, right?
Okay. Good deal. So Stewart, on the deal front side of things, what are you seeing in the market, particularly from an add-on acquisition standpoint around multiples? How is it influencing what you're buying and how you're trying to strengthen your companies a little bit differently than maybe you have in the past?
Sure. Just real quickly, I'll say that we have not seen as dramatic an impact, whether measured based on volume or price, as I would have expected, given what went on in the public equity markets and most other markets in the first half of the year. Now, I will say, for the 35 years I've been doing private equity investing, there's always a lag. But I am now asking myself whether this is a lag or a disconnect. I mean, I realize classical economic theory would say all markets, must converge, but there's not a lot of evidence of that yet. I think I can point to some possible slowing in volume now, finally, but it's kind of still anecdotal. In the public markets, the M&A is down quite a bit, but not in the private side. And I can't really yet point to a lot of price change with respect to the high quality assets. They're still very much in demand. In fact, you could argue that buyers are becoming more discerning and therefore ascribing even more desire and expressing higher multiples for the best companies. We do have a fund at Riverside that focuses on value investing, and they are swamped with opportunities. I think that's not that piece perhaps is not surprising. You asked specifically about add-ons. Add-ons remain the single best arbitrage available to your network. We last year did 75 add-ons to companies we already own. I expect to do that or more this year. A period of high inflation, all the things we're talking about have to be factored in as you think about the value you're going to ascribe and the synergies you're going to count on from that add-on. Having said that, you can ascribe synergies. You start with native knowledge. And in a period like this, it is possible that some of by definition, many of these add-ons are not perfect companies. They have customer concentration. They have underdeveloped management teams. Again, we work in the small end of the middle market. And those sellers may now be saying to themselves, perhaps it's finally time for me to sell. I'm going to get a pretty darn good multiple in this environment for the company I've built. Yes, I could continue to own it. I could continue to work to grow it, but I'm going to be, that battle is going to be more uphill. And I'm not likely to see a lot more multiple appreciation given what's going on with interest rates and inflation. So maybe now this is finally the time I should listen to my advisors who have been saying for a long time, don't have all of your net worth tied up in one illiquid asset.
And from a management team standpoint, obviously integrating add-ons is always a really important task. Are there any elements of the integration initiative that are coming under, more acute focus in this particular environment?
I don't know that it's changed, other than it just seems to keep getting more and more so. The urgency with which we have to approach it, the intentionality with which we have to approach it. I'm not close enough to say myself, but have we added some more lines to the hundreds of lines we already have on the PERT charts when people do add-ons? Like we probably have. It is. Add-ons have historically been the single best way to create value, as I mentioned, at the companies we already own, but it's also been one of the fastest ways to destroy value done wrong. So the stakes are raised. Fortunately, we've gotten better at it, more experience, more reps. Our advisors have gotten better, or we found better advisors. Once upon a time, there were famous statistics that the majority of all add-on acquisitions, I'm not talking specific to private equity, but in M&A in general, don't achieve what they set out to achieve. And our experience is actually that the vast majority of the add-ons we do meet or exceed what we set. And I think it's a matter of just getting better at them.
And Annmarie and Chris, when you think about, the model of the arbitrage you want to achieve and then the post-integration synergies, are there one or two items where the elite management teams that you've seen do it really well tend to distinguish themselves from the pretty good but short of great management teams specific to integration of add-ons?
Well, I think elite management teams, by definition of elite, do everything better. So of course, they'll probably do M&A better as well. I think having we often use an external consulting machine that will come in and bring the PMO discipline to our acquisitions, independent of the elite or very good management structure. But I think it's focus. I think it's alignment, being very clear on what you're trying to do, being very focused on making sure you're doing what you need to do, what you said you're going to do, what you have to do in order to, put the two companies together, build the synergies that you're expecting. And I also think it's being really courageous about, can the new leadership team or the needed leadership team do what you're now needing that organization to do? And oftentimes what I see the less elite think about is we can keep building and keep building and keep building and not change our management system and structure and capability. And so all of us are nodding, more does not make you a better executive. Being a better executive makes you a better executive. I think coupled right now with all of what we've just talked about, we have a capability in that we've not grown in our leadership development machine heretofore, unless you're older, which is this whole skill and capability about what we just talked about, running organizations operationally excellent in an inflation, almost recessionary environment. It's very different skill set than grow and be forgiven for some of the little sins you might have along the way. The room for sins right now are, pretty small. And so you've got to be really good at what you're doing. You've got to be really strategic and focused. Your value creation plan has to be spot on right. And you need a management team that's got the skills and capabilities to do really hard work and do it fast.
And odds are there's nobody at the company that's lived through a period like this before, just
Exactly.
looking at the math and what Kristina shared.
Exactly. Yeah.
And I think we see the same thing. And Annmarie, and she and I have talked about this a little bit before, but thinking about taking those lessons from the public market, and whether you're in the public market or the private market, the management teams, and again, whether it's organic or inorganic growth, the ones, not to sound too simplistic, but the ones that are very focused on the fundamentals of growing profitably are the ones that have the most success, have the most stability of their employees, have the greatest path to enterprise value creation. And so I think that the sort of myth of hyper growth it covers all sins is sort of long. While it was always outdated, it's probably been recognized as being outdated at this point, and that a solid management team will hold itself accountable, and an investor will hold them accountable for profitable growth, and really balancing those two, and that it's absolutely possible to do both, and it will give you the maximal sort of optionality in terms of retention of employees, growth of the business, and ultimately enterprise value creation.
Wonderful. Sounds like the message to management teams is keep doing what you're doing, but do it better, faster, stronger, be bold, execute, and, lean into this challenge and don't sort of sit back and let it come to you. Yeah. Okay. So I want to be respectful of everyone's time and wrap up by 2 p.m. Eastern. So with that in mind, very special thanks to our 4 amazing panelists. This was, I hope, as interesting for them as it was for me and our hundreds of attendees. I'd also like to give a special shout out to Alice and Mallory on my team, who worked tirelessly behind the scenes to make this all come together. So kudos to you all. And with that said, I wish you all Godspeed and value creation, and we'll see you next time.
Thank you, Rob.
Thank you.
Okay, bye now.
Thanks, everybody.